On May 8, 2026, semiconductors provided the market's strongest rationale for maintaining risk exposure. While valuations remained stretched and plenty of risks persisted, the momentum in chips gave buyers a concrete anchor. The takeaway wasn't that risks had disappeared, it was that one powerful sector had effectively widened the market's margin for error. The real story here isn't just another chip headline, it is the scope of the move. Semiconductors surged roughly 11% this week, providing a necessary counterweight while the broader market dealt with valuation pressure, jobs data, and policy uncertainty. This sector's strength effectively bought the rest of the tape some breathing room. This is where the rally gets interesting. A strong sector can make the market feel sturdier, but it also creates a clear dependency. If semiconductor momentum pauses, the market faces a simple test. Will capital rotate into other groups, or does overall confidence begin to thin out? That question is the primary hurdle from here. The short-term setup still looked constructive. The market stayed above a rising 5-day moving average, and small pullbacks were treated more like pauses than warnings. Buyers were still defending the trend. That matters after a run with several recent records, because it shows investors were not rushing to sell strength. The Intel-Apple Foundry discussion added a second angle. But let's keep it in perspective. These talks are preliminary, the product scope is unclear, and this isn't proof that production has shifted. For markets, the real value here is optionality. It offers investors another possible path for U.S. chip manufacturing to matter. NVIDIA may dominate the headline, but the real test for compute is not just demand, it is the plumbing. The market is increasingly focused on the practical limits of scaling: who provides the capital, how chip access is prioritized, and where operational bottlenecks emerge. Sustaining this pace requires alignment between funding, supply chains, and execution. The latest labor data provided a welcome breather for the rally. With April payrolls up 115,000, unemployment steady at 4.3%, and moderate wage growth, the economy delivered the exact mix equity bulls were looking for. Enough job creation to sidestep recession anxiety, but not so much wage pressure that it forces the Fed to tighten policy. Productivity is currently the primary argument for resilient market valuations. The hope is that improved output per hour allows profits to climb without triggering more inflation pressure. While recent data keeps this outlook alive, it remains an open question rather than a settled fact. Ultimately, if productivity gains falter, those expensive growth stocks will have much less room for error. Mercado Libre showed why investors are still being picky. Revenue and financial income rose 49% to about $8.8 billion, which is real growth, but operating margin was only 6.9%. The market was not rejecting growth. It was asking a harder question: how much does that growth cost? That is why this was not a simple risk-on day. Investors were willing to pay up for the strongest part of the tape, especially in semiconductors. They were less forgiving when the path from spending to earnings looked messy. The rally had energy, but it was selective. That distinction matters. Zoetis provides a clear example of how the market is reassessing defensive stocks. In the first quarter, the company reported about $2.3 billion in revenue, but organic operational growth came in flat. Looking ahead, full-year guidance suggests organic growth of only 2 to 5%. Even for high-quality businesses, slowing growth eventually challenges a premium valuation. To monitor the market from here, look at 4 key signals. First, watch semiconductor breadth. Does leadership spread out, or does the market remain overly dependent on one group? Second, track labor data. The soft landing narrative relies on stability, so a sharp break in jobless claims would be a warning sign. Finally, keep an eye on long-end yields and dollar liquidity as the primary pressure points for the broader trend. To wrap up May 8th, semiconductors gave the market a wider margin for error, but they did not remove the underlying risk. The rally continues to find support where leadership is strong, the labor market remains steady, and productivity hopes persist. Yet, the question for the coming sessions is clear. If semiconductor momentum slows, another group will need to step up to keep the structure stable.